Do you know that some companies actually grow smoothly as they expand while some collapse? A big part of this is actually how the finance team is structured. Welcome to Toyosis Finance Nuggets, where we break down money, business, and strategy in simple terms. In today's video, I'll be analyzing the difference between the finance team of a startup and that of a group, why that difference actually determines whether a company scales or breaks. Let's take a group with 20 different entities in 20 different countries, for example. At that point, the finance team is no longer just tracking numbers, it is controlling risk, managing cash, and also ensuring scalability. First, as a group, you need accountants in different countries because the rules for each country actually differ. It could be IFRS in some countries, which is International Financial Reporting Standards, while some companies could use GAAP, which is generally acceptable accounting principles. So, to ensure compliance in each country, you should have accountants in all the different countries to help you stay compliant. Because if you misreport taxes in one country, for example, you could actually attract millions in fines or even legal issues. So, accountants are not just reporting numbers at that point, they're also helping you to protect against regulatory risk. Next, we have plant controllers that helps to ensure operational efficiency. If it's a manufacturing company that has a plant or a factory, you have controllers that will be monitoring production and cost. Let's look at Tesla, for example. It's a manufacturing company. If the production cost per car is actually too high, even with strong sales, the profitability is still going to suffer. So a company can actually be scaling revenue really fast, but if production is inefficient, then it's just scaling losses. Next, we have management accountants. Using Amazon as a case study, the management accountants will be helping to decide if the company should invest more in logistics, in cloud, or even retail, for example. So with this, the leaders are not going to be making decisions based on assumptions or guesswork. They'll be using actual real data. Next, we have the accounts payable. The accounts payable team actually helps to build control and trust with suppliers because they ensure the suppliers are paid correctly and on time and prevent fraud. Let's look at a company like Unilever, for example, that have maybe 20,000 suppliers in different countries. If payments are not made correctly on time, the suppliers could actually stop delivering, and this could actually cause a disrupt in supply chain. Also, we have the accounts receivable team. This team will invoice your customers and ensure that the customers pay on time. Ultimately, if cash doesn't come in, the business could actually run into trouble. Then we have the treasury team, which actually manages all the cash that comes in. So imagine a company in 20 different countries, 20 different bank accounts, 20 different currencies. It's the job of the treasury to actually manage this cash. Next, we have financial controllers. They ensure accuracy and accountability. They ensure that the number that the company is recording is actually accurate and not misleading. Think of a scandal like Enron, where the financial reporting was actually misleading. So imagine the leadership team working with wrong numbers. They're actually making wrong decisions at scale. Next, we'll have the consolidation accountants. The consolidation accountants help you to see the big picture. They consolidate all the financial statements of all the different entities into one group report. Think of a group like LVMH that has different companies such as Louis Vuitton, Dior, and so on. Without consolidation, you would actually not see the full performance of the group as a whole, and you cannot manage what you cannot see clearly. Then we have the CFO who oversees the financial strategy of the company. Think of a group like Apple. The CFO actually plays a key role in decisions such as should we be buying back our shares from investors? Should we be investing more in research and development or marketing? What is our investment strategy? What is our pricing strategy? Are we good or should we be adjusting this? So the CFO is not just tracking numbers, they're actually helping to shape the future of the business. So if you look at the finance team of a startup, for example, it's actually very lean, it's more generalist. One person is doing a different number of functions. While for that of a group, it's large, it's more specialized, and it's focused on scaling without losing control. Ultimately, the goal of the finance team is not just to track numbers, it's to help in decision making and to help the company avoid making costly mistakes like running out of cash, for example. Thank you for watching today's video. If you found it useful, give it a thumbs up and also follow at Toyosis Finance Nuggets. Goodbye.